Bob, in spite of the fact that you declared that I have central bank experience, I'm getting the feeling like, what am I doing in a room like this? I'm going to be stretching my liberal arts degree from St. Lawrence University to keep up with the great work that's been presented here. So, Five Star Bank is headquartered in upstate New York. A little background on the company. We are a 53 operation retail banking distribution network. We operate from Buffalo halfway to Syracuse and Auburn, New York, down to the Pennsylvania border, in the west to Jamestown, and to the east to Elmira. That's 15 counties and it's 10,000 square miles. It's very consistent, Julie, with how you described the heartland of America. We operate 35 offices in towns and villages that have one traffic light that where we are one of the key community stakeholders. Our community bank platform, Five Star Bank, is complemented by Scott Danahy Nayland, which is a locally headquartered Buffalo-based insurance brokerage company, and Career Capital, which is a wealth manager based in Buffalo. Both of those fee-based activities, we think, complement our community bank, the fundamental opportunity to drive relationships. And we are days away from hitting the $4 billion milestone. So in spite of the feeling, what am I doing in a room like this, I want to thank you for the opportunity to be here. I'm very proud to represent the community banks and responding to the panel. And certainly welcome the opportunity to engage in healthy and constructive dialogue with our regulators. I want to acknowledge the work that's been done by the authors of our paper. This type of research was very interesting to me, and certainly I think can be critical in terms of thinking about the effectiveness of bank regulation. So to begin with, I want to agree with the premise that regulatory staffing and other challenges which impede or limit the level and substance of interaction between banks and regulators can lead to unintended adverse consequences. As CEO of a company, as CEO of this bank, as CEO of any company, we're constantly faced with the challenge of dealing with uncertainty as we're trying to operate our business and execute against our plans, and at the same time trying to maximize predictability. So through regular interaction with our regulators, we're certainly able to gain insights and understand better their expectations and key issues that can be incorporated into our strategies that are designed to drive acceptable shareholder outcomes, strong regulatory relationships, great employee experience, and to support our customers. So maybe in terms of my response, it'd be best for me to talk about ways that we've taken some actions to approach some of these issues. So I'm going to hold up, we have, like you would expect, we have a strategic plan. It's 55 pages of qualitative and quantitative information. We boil it down to a strategy map that has 5 strategic goals and 25 related initiatives. If you flip it over, as I often talk about with our team, it ends up serving as a funnel for initiatives supporting the attainment of goals, ultimately driving 2 fundamental objectives that we've defined in our strategic plan, and that is to drive an acceptable shareholder experience. We define that as total shareholder return, but as well strong regulatory relationships. 2 fundamental outcomes. In our strategic plan, the roadmap as to how we're driving our company forward. But for a company our size, a community bank our size, we have also taken and made a commitment to embracing an enterprise risk management framework. So as much time as we invested in working with our board to develop a strategic plan, we've done the same thing in terms of developing a risk appetite statement that links the risk we're willing to take to achieve those fundamental strategic outcomes. And setting a tone at the top and cascading through the organization in terms of risk and risk management. So that has been a major commitment for us. It's been an 18-month journey, and we're almost ready to work our way through the process of turning on a heat map for our board and our management to see. I think that's very important in terms of supporting strong regulatory relationship and strong shareholder outcomes, because it's going to provide us the opportunity to have real-time discussions as a management team in terms of where we are in terms of outcomes that we produce versus expected risk, and therefore what are we going to do about it in terms of making a pivot or adjusting our business activities. And then, of course, we have 3 lines of defense relative to managing risk in the organization. The business units themselves understand where the parameters that we're operating the company in. We have a very strong compliance management program, like many banks, and discussion comments today. We've been investing in talent to increase the capacity of and expertise of that function. And then we have an audit function that serves as a final line of defense. And recently in our company, in addition to the standard risk-based audit approach that you would expect to be standard operating procedure, we've also brought in a new leader of this unit that can help us continue to evolve our audit program, where audit is serving as a strategic partner of management. We want to hear, and we want to cascade their observations through the organization that are constructively critical and things to think about. So for certain conclusions set forth in the papers to be applicable today, we would have to have a complete failure of our compliance management, our audit, and our enterprise risk management programs. So I guess I would take a contrarian view there. As well, on this slide, we're talking about showing the ladder of regulatory oversight that ultimately exists and I think decreases risk at our bank. In our bank, we operate in New York State. We're regulated, governed, and influenced by the Federal Reserve Bank of New York, the Department of Financial Services, and the New York State Attorney General in our experience in the recent past. There's continuous scrutiny as a public company from our institutional investors. They are very interested in our strategy and the risks that we're taking for the rewards that we intend to achieve on their behalf. And there is always a detailed conversation about credit from their perspective in our performance in credit, recognizing to the extent that credit goes in a negative way, that would impair their investment. In terms of the community, that serves as a wonderful governor of great behavior. Community outreach and engagement is fundamental to who we are as community bankers. We are engaged in assuring that we have got the products and services to serve all of the markets, including the economically at risk and vulnerable in our marketplace. We are a stakeholder at the community table to solve some of our most major challenges and opportunities beyond banking, but in the community as well. And we are an employer of choice. We aspire to be an employer of choice. In some of our markets, we are the largest employer, and we need to make sure that what we're doing is operating the bank in a safe and sound manner supports the sustainability of our community engagement as well. I mentioned we're a public company, so we are compliant with GAAP, and we're also compliant with the periodic reporting and disclosure requirements that the SEC mandates. We are audited by the survivor in the Big Four accounting, KPMG, and as well we've issued public debt. We've issued subordinated debt that the structure is grounded in the maintenance of an investment-grade credit rating that's evaluated every year. I would also observe that the CFPB has no physical geographic presence out in the markets, in the banks that they're regulating. They're very limited, and I think their oversight has been pretty effective and impactful. So I think this state of being helps support the idea that this multiple layers of oversight, explicit and de facto, reduces risk in the system. In our personal and professional lives, technology has helped us overcome a lot in terms of barriers, and certainly in regard to our relationship with our regulators, it has definitely overcome barriers and challenges to communication. We are, I think, consistently connected to our regulators in terms of routine calls, emails, and large amounts of information that are exchanged via portals and virtual data rooms. So our interactions are frequent, they're consistent, and I think effective. So I think there's many ways that we can reduce risk in the system through consistent communication. A couple of comments on the information asymmetry. It's not a factor in how we operate our bank and interact with our regulators. Ours is a natural bias to play our cards face up and provide as much information as we have and even more than is as expected so that our regulators understand what we're dealing with and how we're dealing with issues. So when we have requests for increased information, I don't see it as being a factor in terms of increasing our risk at the community bank because our business model is simple. We are driving hopefully low-cost deposits across our deposit base, or across our communities with people we know and lending it back to businesses and people that we know very well. So we're not dealing with complexity in terms of financial instruments or other structures that would drive an increase in risk. And again, the public company scrutiny, I think, is a mitigant there. So relative to originating loans to be sold from a community banker's perspective, that decision is really about a question of driving fee income balanced with the impact on our margin as well as managing our balance sheet and concentration risk that comes along with lending. So it's not about community bankers generating loans to be, riskier loans to be sold off down into the market. So we know our borrowers, we know our communities, and whether to sell production or not, we underwrite these loans as if we're going to keep them on our balance sheet. And that's been the case with indirect loans. It's also been the case with commercial construction loans where we, at the same time we're approving the construction loan, are approving the takeout and to hold on our balance sheet. There were some comments about additional capital. I think that's a great thing in terms of reinforcing the soundness of the system and strengthening the overall system and individual banks. Mathematically, though, for management teams, that becomes harder to drive returns consistent with lower levels of capital. And I think then if we're going to hold higher levels of capital, we must make sure that the context is important. Is there an identified use for it? And if it's for bolstering capital levels across the industry, we just need to make sure that we are managing expectations of our investors and other key constituencies. So a couple of comments, try to keep up with the allowance comments. Our allowance, we know, is our largest estimate in terms of our financial statements, management estimates. Our process is comprehensive. It is subject to significant organizational focus, management time, and oversight of our auditors, of our risk oversight committee of the board, and certainly of our regulators. Our model, as we speak today, is really grounded in three components. We've got a quantitative model embedded in the process, estimates our losses of non-impaired loans with similar loan pools, and risk profile. And that incorporates look-back periods and loss emergent periods. We also have a piece of the model that's grounded in qualitative factors that, subject to regulatory and accounting guidance, is dealing with factors that aren't captured in the quantitative models. And then, of course, we're dealing with the impaired loan analysis and regulatory guidance. In the 12 years that I've been at the bank, I've seen this very productive and constructive evolution of our model, the practical application of balancing and the empirical data with the exercise of judgment. However, as we've continued to work with our auditor, it's clear that they, too, are under increased scrutiny in terms of the conclusions they're drawing relative to opining on our financial statements, and there's an increased accountability there. So at the end of the day, right now, we're feeling that it's driving to a much more precise, less influence of exercise of judgment, and in my opinion, potentially more volatile in terms of the metrics associated with provision and the allowance. But at the end of the day, it's kind of a Goldilocks, in my view, that it's just right in terms of supporting appropriate and adequate levels of provisioning given the facts, performance of our portfolio, and where we see the future going. So, in summary, thank you for having me. I view this regulatory oversight with more optimism than was set forth in the research papers discussed today. And I would also submit that any potential lapse by one regulatory agency would be effectively addressed by oversight provided by other third parties, which includes state regulators and officials, credit rating agencies, shareholders, review and analysis, internal and external auditors, and unfortunately, as we know, a very active plaintiffs' bar aggressively mining for litigation against financial institutions. In support of this view, I point to there was an article on August 30th in the American Banker, and the article was titled "States Preparing to Pick Up Slack if CFPB Backs Down," in which it was noted, quote, "In recent years, states have become more aggressive in their oversight of the financial industry, a trend that could be traced back to the Dodd-Frank Act and growing sense that consumers must be protected from types of predatory actors that caused and exacerbated the financial crisis," end quote. Nicholas Smythe, the head of Pennsylvania's new Consumer Protection Unit, was also quoted, quote, "That's one of the great things about the state AGs. Even if things shift at the federal level, the states are always going to be working hard to protect consumers," end quote. So with that, I respectfully thank you for the opportunity and look forward to the Q&A.